waters, but not sure where to start. Understanding the different purposes, processes, and types of investments can be intimidating at first, especially if you've previously focused on saving opportunities. While building a strong savings foundation like your emergency fund is important, balancing the risks and rewards of investing can help your money grow over time. Bonds, stocks, mutual funds, and exchange-traded funds, or ETFs, are four basic types of investment options. They have the potential to earn a high return, but they also carry a greater potential for loss if sold when the market is lower. Bonds and IOU to you. Governments, municipalities, and companies issue bonds to raise money. The bond is essentially an IOU from the issuer that promises to pay an investor interest over the life of the bond, plus repay the amount invested, the principal, at a certain due date, known as maturity. This is a way to invest while still minimizing risk. It can also be a way of ensuring an income stream since bonds often pay interest twice a year. Some bonds, for example, many municipality bonds also carry tax advantages. There are still risks involved, however. While U.S. savings bonds are considered one of the safest investments, bonds issued by individual companies or municipalities may be risky if the issuer runs into financial difficulties. The issuer can also buy back the bond, which effectively pays the remaining principal balance in full and cancels the bond. Stocks, a piece of a company. Stocks are a type of security that allow an investor to own a share or a piece of a company. When a company wants to raise money, it will sell shares of its stock. If the company performs well, it may pay its shareholders part of its earnings, called a dividend. Stock owners sometimes also get voting rights at shareholder meetings. Stocks have a great potential for growth over time. However, they can also carry a great deal of risk, as the stock market can fluctuate greatly. If you purchase a share of stock and the price goes down, when you sell it, you will lose money. Mutual funds, a more diversified option. It would be difficult for an individual investor to own many shares of a variety of stocks. It might also be hard to pick which stocks to own. One way to get past this is for an investor to buy a share in a mutual fund, which is a pool of money from many investors. Mutual funds may invest in stocks, bonds, or other securities, a combination of these, depending on the portfolio, or a selection of funds. Mutual funds investments are outlined in the fund's prospectus. In an actively managed fund, an investment advisor picks the stocks, bonds, and other securities in which the fund invests. Their goal is to outperform a stock market index, such as the S&P 500, by performing investment research and analysis. However, the majority of managed mutual funds underperform the corresponding market index. An unmanaged fund, or an index fund, seeks to track the performance of a stock market index. Another type of fund is a target date fund. This fund is managed with a specific time horizon in mind. Typically, the time frame relates to retirement dates. The further away you are from retirement, the more aggressive the fund choices. When retirement is closer, the fund will transition to less risky investments. The Thrift Savings Plan is a collection of stock and bond funds, similar to a 400 and ONIC retirement plan. Four of the funds F, S, C, and I are index funds, while the G fund is a government securities investment fund. The last type of fund is a life cycle fund, which is a type of target date fund. The TSP offers additional investment options through its mutual fund window and additional costs and account requirements. Mutual funds tend to be less risky than individual stocks because they are more diversified, meaning they contain a mix of investments. However, they do still carry risk because the shares can lose value if the underlying companies or the market face financial difficulties. Mutual funds also have expenses and fees that can eat into returns, sometimes ETFs another way to diversify. Similar to mutual funds, ETFs allow investors to pool their money when investing in stocks, bonds, or other assets. However, ETFs differ from mutual funds in that they are traded on the national stock exchange at market prices. As with all types of investments, make sure you understand the objectives, risks, costs, and potential performance of ETFs before investing. You can learn all of that information and more by reading the prospectus, which you can locate through the Security and Exchange Commission's EDGAR system.